This is James Zhang with Full Capital, and today we're here with Jeremy Roll. And Jeremy, we've had a couple of interesting weeks. I thought we'd bring you on to just talk about the market and share some slides on what's going on and get your take. So maybe give the audience just a quick background on yourself, and then we'll jump in here.
Sounds good. Thanks for having me on today. Really appreciate it. I know it's really crazy times at the moment. So we're recording this on, is it March 25th today?
Yeah. Yep.
One of those two. And obviously there's just a ton going on. So I'm really excited to be talking today, especially with your knowledge as well. Do you want me to give a quick background?
Yeah, that'd be great.
Okay. So, I've been a passive cash flow investor for about 18 years, full-time passive cash flow investor since 2007. So it's been about 12 years and almost 13 now. And, we're here to talk today about what is going on in the markets, what our opinion is about where things might be heading, and just trying to help everybody to just with another opinion. We're one of many opinions you should probably get. I wanted to say I'm not a financial advisor, investment advisor, accountant, attorney. So anything I'm sharing is just my perspective as an investor. But I have been through, previous cycle. I actually got into all this after the dot-com crash. So I've kind of been through that cycle as well. And, this is obviously a little bit unprecedented. You're going to see some numbers in these charts that are really, truly off the charts, actually. This is like where the phrase came from, unfortunately. So we'll try and sort out, where things are heading here.
Great. So what I'm going to do, this is sort of like, I don't know, like a news commentary that we're going to try to do. I'm going to pull up a chart and Jeremy and I will just sort of riff on it for a little bit, then we'll move on to the next one. So this is a chart from Green Street Advisors. Neil Balwa had this in his presentation recently, and it showed REIT prices sort of since the peak. And so when you look at this, Jeremy, any surprises, or are these pretty straightforward of, anywhere from 50% down to 15% drop in REIT prices since the peak?
Yeah. So, REIT prices being publicly traded companies are obviously going to be a little bit more in tune or in parallel to what's going on in the market. So they're more susceptible to having those swings, which is actually one of the reasons why I don't like investing in publicly traded REITs myself, even though you get more liquidity. But I do think there's some interesting notes in here. And by the way, everybody should know I'm invested in almost every single one of these asset classes. So I'm just hyper diversified. So I'm actually quite surprised about senior housing, only because if you talk to people in the industry, yes, they're having a lot of challenges and they have the ability for wires to come in and actually wipe out some of their community, and other people tend to leave when it's there and they just, they vacate. But at the same time, senior housing is like the next best to a hospital as far as how a lot of these are run. And the ones that are really well run have very specific procedures in place for cleanliness to avoid people from getting viruses, bacteria, et cetera. So ironically, this is actually one of the safest places for people to be if they're going to be amongst other people versus just being at home, for example, when they're senior. So I'm surprised by the level of that, and it's actually good information, I think. Skilled nursing and senior are kind of all lumped together. So lodging is no surprise. I would say that student housing is no surprise. Malls are no surprise. Another one that surprised me, I already talked to James about, was the fact that manufactured homes, and I'm assuming those are manufactured home communities or mobile home parks, those are down, for example, more than retail strip centers. And the only thing I can think of with that is that because they tend to do reasonably well during a downturn, is that they came a very long way and were very cap rate compressed in this previous cycle. And I think that they're kind of reverting to the mean, which is what I've been expecting in the industry to begin with, and I'm looking forward to in terms of new opportunities. So I think that the manufactured home line there is probably that deep because of that, and not necessarily reflective of how they're going to perform necessarily during the downturn. I think that a lot of the rest of it probably makes sense. It's interesting. Office, looking at that, you would think it'd be down more, but it's probably already a little bit depressed, right? So it's probably not trading at a crazy multiple to begin with. And then the ones that are more obvious, medical office and self-storage, seem to be doing very well. Self-storage doesn't surprise me based on the way it performed in the last downturn, and people tend to vacate, double up, move back home. They need a place to store things. Combined with the fact that there's a pretty big trend of people that are going to be retiring in the next 10 years, some of them moving down south, and there's going to be more demand for self-storage in certain key areas. So that's not surprising to me. And, it's interesting, data centers, and I've actually had investments in those in the past, and or indirect anyway, and cell towers are one of the only things I haven't invested in here, and that's not a surprise either. So I think this all makes sense, but I'm really glad you put this up, just because it really shows how you have to be careful right now looking at senior housing. Obviously, hotels are obvious, and then some of the other asset classes. To me, the biggest surprise on this entire chart is the degree of senior housing has gone down, as well as the fact that the manufactured home communities are actually where they are. I would have thought they'd probably be more in line with medical office and self-storage, honestly.
Do you think anything about manufactured homes just from the tenant base, maybe, in terms of, no?
No, I'll tell you what I found in previous cycles, and I've researched this and talked to people who've been investing for decades in this space. What typically will happen is that since they're the lowest cost option for people to live in, short of certain like short-term motels, hotels, et cetera, which aren't really homes, the occupancy rates typically will drop because some people lose their jobs. Maybe they'll have to go live at home, whatever. But the rents tend to hold steady because there's still demand for that product to be able to then find a new tenant. So often, even though vacancy will go up because nothing is immune to any downturn, regardless of whether it's as, crazy in terms of and deep as what's going on right now, or just a regular recession, nothing's immune to a downturn, but they tend to hold the pricing pretty well because it's such a low cost option, and you tend to be able to replace a tenant quite easily and quite quickly if you're in a highly occupied park in a really strong demand area. So I really believe that this is reflecting, and I could be wrong, but I really believe this is reflecting the fact that cap rates have just become so compressed and multiples came up so much compared to most other asset classes that it's just reverting to the mean, and we're now having it just kind of decompress a little bit.
Do you think apartments are priced correctly there, just sort of right in the middle, just with where they are? I mean, most of our investors are apartment guys. So where do you think that should be?
Yeah, I think they're probably in the right zone because, I think there's been a bit of a misnomer. A lot of people like to say that someone always has a place to live. And actually, I agree with that theoretically, but practically what they miss is the fact that in a regular recession, people will lose their jobs. They'll have to either go to a lower class type of apartment community, or sometimes they'll actually double up with other people, or they'll move back at home. And so that will create more vacancy, which will also lead to reduced rents, et cetera. So I think it's probably right in about the right place. I do think it's actually a little bit more susceptible than self-storage and some of those others. So I think it's exactly in the right place.
All right. So this just came out this morning. When we talk about off the charts. So what are your thoughts on 3.3 million people filing for unemployment this past week?
Look, this chart will leave you speechless when you realize that the data is going all the way back to 67 and you go much further back and there's nothing like it. Here's what I'll say. I personally think that if you own stocks in Wall Street, I think they're not pricing in a degree of continued employment claims we're going to see in the coming weeks. I've already heard and read studies saying that next week will be worse than this week. And so the chart you may need to adjust the chart next week even higher. And it's just obviously a catastrophe. I mean, there's literally, before we press record on this podcast, I asked James if he was going to make me throw up. And this is the chart that makes you throw up. I mean, it's just unbelievable. These are numbers on this page, but when you think about how it affects people and lives, then how many people it affects and how quickly it's happened, it's, a lot of people like to use the word unprecedented, but this is actually, like, you see the chart, it's really unprecedented. So I really don't know what else to say except for the fact that the shock is just off the charts, as you see.
So you sort of wrote a great email out probably a week or two ago, just about how this forays into the lack of jobs leading into, or really it starts at the business level, right? In terms of maybe go through your sort of small business cycle for us and how it sort of fed into that first table.
Yeah. So you're talking about like the domino effect.
Yeah, the domino effect across.
So I sent an email out to my investor group a couple of weeks ago, and the reason why I did, and I don't normally send emails, and it was an odd email for me to send, but I received a whole bunch of emails from some sponsors that I'm on their mailing list, and like one of them said, "The coronavirus is here, interest rates are lower, that's great," and I was like literally, what are you talking about? That's great, interest rates are lower. I saw some other ones are like, we own apartments. People always have to have a place to live. We're not going to have any major effect from it. And I just saw enough of these that I kind of got fed up. And I created an email that just showed in a recession, regardless of whether it's to this degree, off the charts, crazy, or any normal one, the ones at the bottom that you see. Basically, what happens in a recession is that people lose their jobs, right? And then they have no more income. They have to double up, looking at apartments, for example, or they have to go to a less expensive apartment, or they have to go live back at home. That will effectively increase your vacancy rate at your facility or your apartment building, which will then lead to lower pricing. And not just because you're trying to fill that spot up, because everybody's getting more vacancy around you, and therefore there's more supply. The demand isn't the same as it was. And the way supply and demand works is that the equilibrium is going to come down on pricing, right? And of course, that feeds into a reduced NOI and a reduced value for your property. And by the way, another thing that happens is that investors get scared. They've just lost 30% of their net worth in many cases. They're scared plus lower net worth, and they don't want to invest. So now you have less demand from investors to participate, you've got a lot less buyers coming into these properties. And that type of effect, the psychology and the lack of net worth now actually adjusts supply and demand in terms of buyers and sellers of properties, which actually then leads to cap rates going up as opposed to down. And so that leads to pricing going down. So you've got all these dominoes that occur in a regular recession. And no matter what someone says about an apartment community being immune, it doesn't matter which asset class it is, every single one will be affected.
Yeah, this is a painful chart. So once everyone sort of absorbs this chart and says, all right, yes, we are in a recession, everybody admits it. KPMG put out this chart, sort of had Q1 down, Q2, Q3, Q4 down. That's for this year. And then maybe I'll jump over to this one. So they're forecasting sort of coming out of this sort of late 2021 and then early 2022. I mean, do they have any idea what they're talking about? Or are they just guessing? Like, does this seem reasonable to you?
Well, it's an opinion, and it's, there's obviously a lot of variables that go into what they're forecasting. So I don't want to downplay it, but what else? I'd read about 1 to 2 or more hours a day of economic news to try and stay on top of what's going on, to be able to kind of try to stay ahead of the curve and figure out what to do with my investing going forward. And most of what I've seen in terms of forecasts, and a lot of the forecasts tend to be optimistic, as they always are, just the way it works, but because there's also some vested interest in them being, positive. But this one is probably one of the most pessimistic forecasts I've seen as far as getting back to positive GDP only in 2022 or maybe late 2021. That would be, I think, a very, very, assuming that if we all agree that a recession started in Q1, for example, then going through, let's say, 8 quarters of, negative GDP is very unusual. A lot of the recessions are 2 quarters, maybe 3. So even 4 or 5 would be a little bit unusual. So this is a bit of an extreme forecast, I think. But then again, there's a lot of variables that are going to have to unfold here before we can really figure out what's going to happen. The number one thing I've been trying to figure out is when are things going to go back to normal in society? Because once society becomes more normalized, people will buy things and they'll go back to work, and then this will all start to get better. And, there are vaccines that are projected to be available next year in 2021. That seems probably realistic based on everything I've read, even though normally it wouldn't have been in the past. Technology is going to enable it, hopefully. But the one thing that I am hoping for, and I think a lot of people aren't talking about, is my hope is that from what I've read and kind of sorted out, I think the therapeutic antiviral medications are going to be available probably. I think there's over 75% chance that at least one of them will be deemed effective through clinical trials and usable. And I think that they'll probably be available in decent quantities because some of them are already starting to produce them in advance of thinking that they're going to work out. So they're going to have think about millions and tens of millions of these. But I think that they're going to be available probably in August or September, if I had to guess at the moment, based on my, that's subject to change. And I can see, for example, kids being required to take those medications to go back to school, so none of them will get it, because you can actually take it, some of them proactively, and avoid getting it. And then they'll have them for the medical workers, they'll have them for the elderly, and then eventually, we'll go back and, to work, and people will actually go back out there. And the other thing also that's a possibility is that we could test everyone's antibodies and determine who's already had the virus. For the 80% of people who didn't even know they had it, every single one of those people can theoretically go back to work. What I've read about the virus is that it mutates extremely slowly, and therefore it's going to be easier to make a vaccine that will work for a longer period of time. And it's also much more likely than in your country that you can actually go back to work and not worry about getting a different strain of it. That and I'm not a doctor, but the point is that if you've already had the virus, then you can go back to work. I think the challenge with that possibility of doing the antibody testing is that I don't have very much faith in being able to test 300 million people when they can't even test 1 million people at the moment, right, having the kitchen sink at this, to begin with. So, and the test is different. I think it's a blood test. This is a swab test. It's different, right? But anyways, those are just some thoughts. And so to me, if we go down the path that I think is the most probable right now, then the GDP is going to rebound much sooner than this chart shows. But, time will tell.
Okay. So then I just like this historical chart. I mean, we mentioned this earlier, but most of these recessions are about 2 to 3 years, I guess, per this chart. And then we pop back out. So that's probably what they're going off of a little bit, is sort of just historical recessions. Anything different about maybe this one versus the 2000 or 2008 one that you see?
Well, just one thing, just in interpreting the chart, I just want to point something out to you. So the recessions aren't really 2 or 3 years. The recessions are the gray bars. Okay.
Right.
So a lot of the recessions are maybe 1 year, 1.5 years total. And so we were talking about this offline before, but James made a very good point, I thought, which is that, if you take a look at when the best time is to buy, that, you can look at about 2 years out and you see that we're back to like normalized GDP levels roughly. And so, I don't know if you want to expand. That's actually, you should get credit for that. So I don't know if you want to expand on that.
No, I've mentioned it before. I mean, what I did was, some general partners have said, look, if I see 2 negative quarters of GDP, I'm going to stop distributions and sort of batten down the hatches and make sure I get through the recession. So why don't we just flip that over and say, all right, when I see 2 quarters of positive GDP, I'm jumping back in, because if you look at like let's say the 1990s, the 2000s, 2008, like once you saw 2 quarters of positive GDP growth in a row, whether that's 1% or 3%, it had a run of 30 quarters or 40 quarters. And so if most people's plan is to hold these deals for 3 to 5 years, that gives you enough runway, because everybody's always worried, like, how do I catch the falling knife? Right. And so I just thought that was a very high level way to look at it from a cycle perspective.
Yeah, I think historically it takes about typically 2 years for the price to bottom. In real estate, it's a very slow moving kind of price discovery. So that's kind of what I'm banking on. And one thing I just realized, I was thinking through as you were just talking about this, though, there is one caveat to what you're saying that's different. And I am not a fan of saying it's different this time. Like, I really don't believe that most of the time. I really don't even operate under those assumptions most of the time. But if we can't get the antiviral medications together working effectively, then what's likely to happen, if you look at like the Spanish flu and everything, that there will be a second wave, probably in the winter. And you may have 1 or 2 positive quarters of GDP followed by negative quarters again, if we're like trying to get our arms around it again. So this time you have to watch that, because if it wasn't this particular virus, I think that your 2 positive quarter of GDP makes perfect sense, but that's just the one thing to watch out for.
Okay. Yeah. I mean, I'm looking at this chart. I mean, I guess if you go back to sort of, early 1980s, it sort of popped up there and then came back down pretty quick. And so, that window was a little bit narrower, but just in the last 3 or 4 expansions, it's had a good run. So maybe that's why this KPMG person said, all right, 2021, we're going to get through the winter. And then 2022, we'll see how that goes, and is building in a little buffer there.
It could be, in fact, Hong Kong right now, if you want to look forward a little bit, is already having a third wave. I mean, these are minor waves, but they're having a third wave, theoretically, of trying to get their arms around it already. When they thought they had it, then they didn't. Then they thought they had it, then they didn't. I think that our wave would probably be a little bit like higher and then down, and then could be higher than that, as opposed to being smaller waves that they're dealing with. But that's something to watch as well. So it's tricky. And honestly, my silver bullet at the moment is the antiviral medications, because there's a number of different ones already in trials. Some of them are very promising. And I think that that's how we get the psychology dealt with. What's interesting to consider about those antiviral medications as well is that the way that a lot of them work is they actually stop the virus from replicating in your body. Once you know you have it, you take it and it stops it from replicating, and then your body actually deals with getting rid of it. And so what that means is that you can actually take a virus that was going to kill somebody and stop it before it can kill somebody, and even keep them off a ventilator. So the hospitals won't be as crowded. It'll be treatable. And what's really interesting is that actually takes the death rate down. And so then you can start telling people, look, the death rate's now, half or, 1/10 of what it was, because people are getting access to this medication. Now it's actually like the flu, right? Because not the exact same, but from a death rate perspective. And now people are going to say, okay, well, it's the same death rate as the flu. I really shouldn't be scared about this, and we'll get people back to normal. So I'm really hopeful that that's going to have some positive effects, but we'll have to see.
So after all that news, what do I do now, Jeremy?
So, I'm not a GP. I've never been a GP. So I'm just we came up with these bullets before we started this, and just some brainstorming. But I've talked to I'm in over 70 LLCs. I've talked to a lot of sponsors already, just to see what everybody's planning. I'm more out of curiosity than anything. Number one, cut expenses, both personal and on the property, all different expenses. I see some people who are being very proactive, just all hands on deck, stop every payment. I saw one sponsor say to me, I've already stopped every single recurring payment on my credit card. Like, I actually stopped the credit card from being able to be charged. So they just didn't care. They were going to spend a week or two revisiting every single line item and determining what should be done and not done, and what can be deferred and not deferred, as we're talking about in the second bullets, and then turn that back on. So deferred payments strategically, I think, makes a lot of sense. Some of them that I've talked to are being more proactive with tenants than others, but that might be a good strategy depending on your situation. I've actually seen a mix of all different strategies. One person told me they actually studied other shocks in the past, and they came to the conclusion that the most effective strategy was to actually defer, and this is multifamily, to defer payment for a month and then spread the payment over the remaining terms of that person's lease for the year, whether it was 12 months, 6 months, whatever it is. And they said historically that had actually provided the best outcome in a shock type scenario, whether it was some type of natural disaster, et cetera. So that's what they were planning on doing. I've seen other people who are just waiting and seeing what tenants have to say. I've seen other people who are maybe going to cut people's rent. They're actually offering, they're saying, if you pay by the 1st, I'll give you a 20% reduction in rent. If you pay by the 5th, you'll get a 10%, or whatever the numbers are, right? Everyone's handling differently, but the common thread is a lot of people are being proactive and some aren't. And then negotiate with lenders, that's going to be the key, right? So I don't need to tell everybody out there, if you own a property free and clear and there's no debt, this is a lot more manageable, right? So debt is probably the single most important component if you have it, both in terms of expense and how you actually get through this. And each lender type is different. James, I'm sure, is very familiar with the fact that the agencies have already, given specific deferrals, or I don't know what you want to call them, and you can get into that, James. But a lot of lenders haven't really been forced to do anything yet, and nobody knows what they're going to do. So negotiating may be a good idea. As soon as you have the data behind who's paying you, not paying you that month, you can take it to the lender and start to be as proactive as you'd like. James, you're going to say something.
Yeah, I mean, Jeremy, I didn't prep you for this, but essentially what they're telling general partners is you can forbear, but you have to pay it back within 12 months. Mm-hmm. And the whole time that you are in forbearance and until you pay the money back, you cannot evict anybody. So even if the courts even if Dallas County opens tomorrow, but you're in forbearance for May, June, and July, you have to pay that money back and you can't evict anybody until you pay those payments back. So some people, like the way Fannie and Freddie put it out there, it just seemed like free money, sort of like these stimulus payments that are going out, but it's not free money. It's essentially you're getting a 90-day forbearance and then you have to pay it back within 12 months.
So actually, I'm glad you told me that because I heard every part of it except for the fact that you can't foreclose for the year. I'm sorry, you can't evict.
Can't evict, yes. So number one, you have to pay the money back within 12 months. So that's pretty quick turn. Some people were thinking, okay, I'll forbear now and then just put it on the back end. When I refi or sell, I'll pay it off. But no, you have to, eventually you got to get that money from somewhere. Either you're going to have to get the money from investors or you're going to have to get that money from the existing tenants. So that's why I actually like your strategy of, all right, let's skip this month, but then next month we're going to divide the whole payment by 12 and then put it on the next month, because then eventually you get all the money back, because Fannie Mae is actually making you, any tenant that's been impacted by COVID-19, they're saying you have to give them 12 months before you evict them anyways, if you take this forbearance. So it's almost like that guy already knew that, which is pretty amazing. So that's actually a good strategy, because most people are probably just going to say, well, you can't evict me right now, so I'm not going to pay. But if you sort of give them that plan and say, look, I'm going to not take your money in April, but I need it for May, June, July, then that sort of sets them up and prepares them.
Yep. And I mean, if I was a landlord and I was forced to not evict somebody for 12 months who wasn't making any payments, the only leverage I'd probably have, I would imagine, and I'm not a landlord, I've never been one, so I don't know if this is really, I'm missing something, but you can clearly say, look, if you're not going to make payments, even though I can't get rid of you, you're going to have an eviction on your record.
Right.
Like, there's no doubt I'm going to spend the time and money to get that done at the end. Right. Because what's been interesting, James, is that some of the landlords I've talked to have said, okay, well, now I got a problem because no one's allowed to be evicted for 60 days. And I said, well, can't you really say, like, look, you're going to have an eviction on your record at least, right? And what they said to me is, look, if I can't evict them for 60 days and they leave before 60 days, I'm just not going to bother to go put an eviction on their, right, on their record. But I think if someone's there for many months, I think you'll be more than happy to actually spend the time and money to do it.
To follow up,
yeah, something to consider.
Let's jump over to the LP side. What would you say for the LPs out there?
Yeah, so the most common thing I've seen as an LP investor is people who have just stopped making distributions, right? They want to be conservative. I think it's the absolute right thing to do. I think it can be very painful for some people who are really counting on it, but I think it's the right thing to do in the long term. And so I would expect reduced cash flow and possibly no cash flow at some points in the coming months and possibly quarters. We'll have to see. If you're considering investing in anything right now, there's 3 things that you really need to have. And that will make it probably a lot safer for you to wait until you can get 2021 or 2022 pricing, assuming the pricing is lower. But there's 3 things that I'm waiting for in terms of discovery. I'm waiting for vacancy discovery, rent price discovery, and market value discovery of the actual asset. And until I can see all three, I'm taking risks. So if I go invest in a building tomorrow and it's 100% occupied and I haven't discovered the vacancy that's going to occur in the next month or two, I'm paying for NOI that's probably not going to be there in its full amount. And that's a big problem. Even if the occupancy stays the same, but rents go down, right, in the next few months as you're renegotiating new leases, I'm still paying for NOI with today's rents when tomorrow's rents may be lower. And that's still a problem, right? And if I'm going into that building and I'm paying, the last 6 months comps price, that's a big problem because I'm almost certainly overpaying for it, even if you had no problem with the rents and the vacancy being where it is. So to me, there's a lot of risk into doing anything now, and then add the layer on that we are already facing with an election year, that where probably there wasn't going to be a lot of transaction in the second half of the year with people waiting to see who gets voted in and what effect that can have both from an economic perspective and real estate investors' perspective. Waiting seems to be the smartest thing to do, I think, until at least early 2021. But what I am telling people is if I see anything that I think makes sense, it's going to be asset class dependent. I've got to feel like I'm getting 2021 or 2022 pricing, or it just doesn't make sense for me. And for me specifically, because I invest in more stabilized properties, we're not adding a lot of cushion. And so I got to pay the right price. On the flip side, if you do wait, I think you will be highly rewarded. This is going to be a great time for investors in the next year or two. And so there's going to be a lot of opportunities. I've personally been on the sidelines mostly since end of 2016, waiting for this time to occur. Not to do with hope. I wasn't hoping for any health challenges with it. That's a whole different issue. But eventually a downturn was going to come. That's the way cycles work. So, and then another thing I think people really should think about that I'm not sure that they really do enough is determine your preferred asset classes for the next decade. So I tend to go into deal for like a 10-year horizon for the most part. And for me, I've already identified my tier A asset classes for the next 10 years in terms of when I look for predictable cash flow. So I'm all about predictability because I live off the cash flow, right? So for me, those 4 asset classes that I call tier A for the next years are multifamily, mobile home parks, self-storage, and senior living. Now, senior living, I'm probably going to wait a little bit to see what happens, but I think long-term it's a great bet in terms of predictability and increased demand from an aging population. Mobile home parks, supply and demand is completely out of whack, and it's also the most affordable option. I think it'll continue to be there for a very, very long time, and it's a really very lowest turnover asset class, I think, of all the major asset classes, so a lot great for predictability. Self-storage, probably going to do reasonably well compared to other asset classes in the downturn, and I think in the right locations towards the south and the Sun Belt, a lot of people are going to be retiring, moving down, going into smaller homes or even apartments on a strict budget and may have to store a lot of stuff. So I think that could be a really great play. And then I believe in continued demand for apartments for a very long time. So in the right location, once all of this is settled down, I have vacancy discovery, rent discovery, and market price discovery. That's another great one. But, so you've seen now, I went through all that for everybody because I have a very clear strategy on what's going to work 10 years out, hopefully, in trying to predict trends in society, et cetera, of what's going to work for what I'm looking for, predictability. You may be looking for value add, you may be looking for development, whatever you're looking for, you got to think longer term. So this is a perfect time right now as we're waiting for everything to now come down in price to figure out what should you be targeting for the next 10 years.
Well, thank you, Jeremy. This has been super helpful. I mean, I'm in 20, 25 deals, so I'm trying to catch up to you on your 70 LP deals, but this has been super helpful in sort of navigating sort of the current environment and sort of the wait and see. But then also I like having sort of some guidelines out there so that when those times hit. And so appreciate you coming on. If you guys like this, definitely subscribe to the channel, like the video. And thanks a lot, Jeremy, for coming on today.
Yeah, James, thanks for having me. I hope this is helpful for everybody out there. And then can I share my email in case anyone wants to reach me? Or you're going to do that?
Yeah, that's perfect. Go ahead.
Okay. So, I'm happy to help anyone any way that I can. I'm happy to network with other fellow investors, even new investors. I'm happy to try to help, or even sponsors. I'm always looking for opportunities, other investor groups, whatever it is. So my email is the best way to reach me, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com.
That's perfect. Thanks a lot, Jeremy.
Thanks, James.